the thing that you have that's a big problem is you have quantitative tightening. So the Federal Reserve raised interest rates last year 7 times, and they also they stopped stimulating, as we know, but now they're actually going to QT, quantitative tightening, and they want to run off about up to $95 billion a month from the balance sheet. So that is a liquidity suck from the economy, because if they are selling $95 billion of bonds off of their balance sheet, that means that they're receiving the cash and selling out the bonds. So it's a liquidity suck from the Federal Reserve running off the balance sheet. If we have that happening at the exact same time that we've reached our debt limit, and we have that liquidity being sucked out of the economy, this could create massive liquidity problems. And you guys know I've talked about in 2022, liquidity being the actual crisis that could cripple the dollar at any given moment. You must have liquidity. And the problem is with our US system, we have been a stimulus economy probably since at least 2000, but let's even just say since 2008, 2009, since the GFC. We have completely been a modern monetary theory based economy, 100%. And that means that we are constantly looking to have GDP by pushing stimulus into the economy, low cost of capital, next to zero interest rates, and massive stimulus being pushed in through the Fed on a yearly basis made the markets come up, 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 and up. And that's why we don't have a true organic sense of where they are. So if you talk about liquidity events where the Fed is no longer stimulating, they no longer have a low cost of capital, they're sucking liquidity out of the market because of the fact that they're running off their balance sheet. And then at the same time, you're also talking about running into a debt ceiling problem and having to finagle ways to cover our bills until we can actually get a new ceiling approved through Congress. You're talking about a lot of things that are butting up against each other, causing a lot of problems. So just be prepared, you guys. 2023 is going to be rocky, and I don't think this is the year to go it alone. You absolutely should seek professional management. Seek management that is not going to just toe the standard line of stay in the market. You can't pick the winners and losers. You have to stay in the whole time. This is going to be a rocky road. And if you don't have the risk tolerance to lose 30% of your portfolio, this is probably not the year to start off in equities. I would definitely remain in a dry powder situation. Look at commodities, look at metals, look at things that we think no matter what happens with China and no matter what happens with Saudi Arabia, these asset classes will still perform. You need to be hedged into safety asset classes that will get you bridged from where we are, which is an oversold market, totally overbought, totally too high, still needs to come down substantially more. But it's going to be painful because it's going to happen either through war escalation, Saudi Arabia pulling the trigger, something out of China. All kinds of things could actually make this year go a little bit crazy. But the point I'm trying to make overall is this is not the time to go it alone.